Morning everyone, welcome to ANC News. It's Wednesday the 22nd of June. Today we're talking the RBA, as we well should. Jawboning and what a recession really looks like. Yesterday we heard the RBA chief assure us, I don't see a recession on the horizon. As we've seen repeatedly since the GFC, central banks have deployed words as much as rates and QE in an effort to control markets. Commonly called jawboning. Is that what Mr Lowe is trying on us? Is it true? And if not, what does a recession mean? The biggest threat to global economies right now is inflation. That is non-transitory or under control, forcing central banks to tighten monetary conditions to stem demand for what is predominantly a supply-led problem and into a rapidly weakening economy. Stopping quantitative easing or QE, and indeed in the US deploying quantitative tightening, reducing, not expanding their balance sheet, combined with raising rates, has removed liquidity from the market that has already seen a big plunge in shares and crypto, and now threatening property as well. Raising rates, when you have the biggest debt pile in history, has far-reaching consequences as well. And so inflation is the core issue, forcing their hand to tighten into this mess. Essentially, every modern monetary tightening cycle has ended in a recession. That's a 100% success rate. The problem with inflation is that the fear of inflation begets inflation. What we're seeing now in Australia is evidence that people are trying to front-run inflation by bringing forward purchases before the price goes up. The irony, of course, particularly whilst supply constraints remain, is that in itself raises inflation, and we get this self-reinforcing inflationary spiral. What happens on the other side, of course, is a high likelihood of recession and a void of spending. It is therefore completely logical that Philip Lowe would deploy, she'll be right, nothing to see here, jawboning to try and contain this phenomenon. He states that he expects inflation to hit 7% this year, and that it will be some years, I think, before inflation is back in the 2 to 3% range. Australia, more than most, will likely too feel the impact of so-called wealth effect, where higher house prices fuel confidence and mortgage redraws for discretionary purchases. NAB yesterday joined the list of forecasts seeing substantial house price falls ahead, with their chief economist predicting 2.5% drops this year and a further 15% next year. Combined with less discretionary spending capacity due to higher mortgage repayments, the great Aussie housing dream may indeed be a large contributor to our chances of a recession. So what does a recession mean for investors? Whether you're personally invested in shares or not, unless you have an SMSF, with a nice balance of uncorrelated assets, your super will likely be very heavy equities. The following table we include today in our news, so jump over to nzbullion.com.au. This table is from Bank of America, is a salient reminder of what happens in a bear market, most of which will coincide with a recession. Yes, it is US-based using the S&P 500, but that is the largest index in the world, and we largely follow their lead regardless. Indeed, the world actually substantially lagged the S&P 500 since the GFC and COVID, so it paints a rosier picture. There are a couple of takeaways. First, peak to troughs usually take well over a year. COVID was the deepest and quickest recession in history. It was a clear exception. The GFC saw a peak to trough of 17 months, with lots of false rallies, or maybe a bit like last night, if you've been keeping track. Secondly, the time then taken to get back to where you were previously, so recovery in that table shown, then usually takes many more years from the trough. Relatively, it is the elevator down, stairs back up analogy. Remember too the math of a 50% loss needing you to make 100% on what's left just to get you back to even. And if you haven't thought of that before, if you've got $100 in shares and you drop down to $50 worth of value in those shares, it takes a hell of a lot more energy to get that back up to $100 over many years. Since the turn of this century, seeing 3 recessions and 3 of the 10 worst equity bear markets in history, gold has returned capital growth on average of 8.6% each year. And it also shines when things are looking horrible in the economy. Thanks for joining us for news today. Jump over to nzbullion.com.au if you're looking to purchase, or check out that little bit of data there in that chart that we've included today. Jump over to nzwealth.com.au if you're interested in crypto, and goldsilverstandard.com for our own crypto built and backed by ANZ and real gold. Catch you tomorrow.